Welcome to Capital Link's company presentation series.
I am Nicholas Bornel, President of Capital Link, and I would like to welcome you to the 2025 Capital Link Company Presentation Series. In this series, company management highlights the company's current operations, business development, strategy, growth prospects, and sector outlook. We have with us today Mr. Moritz, Fuhrmann, the co-CEO and CFO of MPC Container Ships. MPC Container Ships is a leading container tonnage provider specializing in small to mid-sized container vessels. The company owns and operates a portfolio of eco-efficient container ships serving intra-regional trade lanes under fixed-rate contracts. The company is listed on the Oslo Stock Exchange under the ticker symbol MPCC, and is headquartered in Oslo, Norway. In terms of logistics, we will begin with a brief company presentation followed by a live Q&A session. Please note that webinar participants can submit your questions anytime during the event, during the presentation, and your questions will be replied in the Q&A session. As a note of the disclaimer, the usual disclaimer, please note that this presentation and discussion is strictly for informational and educational purposes and should not be relied upon. It's not investment advice or advice of any kind, nor an offer to buy or sell any kind of securities. And Capital Link bears no responsibility for the content. And as a further disclosure, we have the great privilege to work with MPC Containers on investor relations. And let us now begin with our discussion. I will turn the floor over to Moritz. Moritz, the floor is yours, and thank you for being with us.
Thank you. Thank you very much, Nicholas. Good morning and good afternoon to everyone. As always, great to have the opportunity to present MPCC during a Capital Link event. We have structured the presentation into three sections. We'll start with a brief company overview, turn into a market update on the most recent events, probably one of the topics of most interest to the viewers and listeners, and then we'll also spend some time on the company outlook before turning into Q&A. MPCC, in a snapshot, we are exclusively focused on feeder tonnage in the container market. We are with a fleet of 62 vessels. We are the largest tonnage provider in the intra-regional trade. MPCC's definition of feeder vessels is anything between 1 and 6,000 TEU. 2024 has been an exceptional year from a market perspective, very good charter market dynamics, and we as a company, we have been able to significantly increase the revenue backlog of the company. We're looking as of end of Q2 24, we're looking at a backlog of $1.2 billion. And on that, and on back of the backlog, we have also increased significantly the coverage for 25 and 26, standing now at 85% and 57% respectively. The good market, not only in 24, but also looking back to 4 years, we have taken advantage of not only changing the business model of MPCC. I will spend some time on the next slide on the business model, but also using the money to significantly reduce the leverage on the balance sheet. We have freed up a lot of collateral. So as of today, we have debt-free vessels worth close to $700 million. We have a very clear dividend strategy, returning capital to shareholders. I will also spend some time later in the presentation on this. We're walking the talk on that topic. And last but not least, we also have a very strong ESG focus. The regulatory framework around shipping is ever increasing, and we're trying to maneuver in that environment. So big part of our strategy is obviously driven by ESG. And on that topic, we have roughly spent around $600 million over the last 3 years, essentially renewing the fleet. And that contains ordering new build, again, long-term charters, that contains buying modern second-hand ships, but also retrofitting existing vessels in the fleet. Spending some time on the history of MPCC. We're a fairly young company. We've been founded in 2017. We raised equity and debt capital in Norwegian capital markets. We used the proceeds to acquire a fleet of up to 80 vessels in a time span of 2 years, so a very rapid growth. There was a transformation period prior COVID and shortly after COVID. And then when the market on the back of the COVID-19 disruptions took off, that was the point in time when the business model of MPCC transformed from being essentially a growth stock into a value stock. We started paying off dividends. Up to date, we have distributed close to $1 billion back to shareholders. And as I mentioned before, the strategy now is really around optimizing the portfolio. We've been selling off older, less efficient vessels, and we have been reinvesting the proceeds in more modern tonnage. Again, we have reduced the debt significantly, and we have started paying out large amounts in dividends. So these are the three capital allocation pillars. And again, also going forward with the backlog that we have been building, standing now at 1.2 billion, there's, I think, good predictability for shareholders looking ahead in terms of dividend distributions, but we will also use the good charter market and the cash proceeds to continue on the fleet renewal. Looking at the fleet today, again, the feeder vessels have a distinct focus on the intra-regional trades. On the right-hand side of the slide, you can see that where our vessels are trading. Our fleet is evenly distributed across markets in the Americas, in Europe, and the Far East, providing a nice diversification, not only in terms of customer base, but also in terms of market opportunities, because there is distinctions whether you trade your vessel in the Far East, in Europe, or in Americas. On the left-hand side, again, some KPIs on the fleet. We're currently looking at a fleet size of 62. More than 2/3 of the fleet are completely debt-free as of today, providing a huge balance sheet flexibility. The average age of the fleet is around 14 years. We're looking to reduce that number as we speak and going forward. And at the top right on the left-hand side, you see again the 600 million investment that we have undertaken, essentially translating into a 40% share of eco tonnage of the fleet today. All this has happened over the last 2 to 3 years, so it has been a rather busy period for the company. Obviously enjoying the good market, but also capitalizing on the very good charter rates and asset values that we have seen and that we also see still today. Again, some highlights on the fleet. On the right-hand side, you can see that our fleet is evenly split between 1 to 2, 2 to 3, and above 3,000 TEUs. Our largest vessel as of today is 5,500, so a nice size distribution. On the left-hand side, some highlights on our vessels. We have 3 dual fuel methanol vessels on order. The first one has been delivered actually yesterday, which was a very nice accomplishment by the company and by many people involved. And the other 2 vessels are being delivered in the foreseeable future, in 3 months' time, and 1 vessel in 2026. On top of that, as I mentioned before, we have heavily invested into eco vessels that we acquired in the second-hand market, buying smaller fleets this year, but also last year. And we have undergone a sizable retrofitting program on certain vessels, and that usually entails changing bulbous bow and propeller, and obviously applying silicone paint. And the first test results of vessels that have been retrofitted show a meaningful increase in efficiency, and we're talking here about up to 20% more efficient vessels than before dry docking and before being retrofitted. Spending some time on the market. Obviously, the last year, the overarching theme has been the disruption in the Red Sea, obviously caused by the attacks of the Houthi rebels in Yemen. Consequently, from a container perspective, the liner companies have decided to reroute most of their vessels around the Cape of Good Hope. The increased sail time of up to 14 days, based on our numbers, has led to an increase in demand of up to 12%, which is a massive number and which has obviously helped also absorbing parts of the order book, which we will also spend some time on later, and led to very good charter rates, which you can see on the right-hand side, essentially showing where freight rates have developed to. You can see in 22 and 23, obviously, the heydays, with a correction in 23, and then in 24 again, going up. As of today, again, some volatility in the freight rates, but as of today, we're still significantly, actually, twice above the historical average that we have seen up until January 2020 of close to 800 from an index perspective. What does it mean from a chartering perspective? We just talked about the freight rates, and now we're looking at time charter duration, but also freights. On the left-hand side, you clearly see the trend that based on the favorable market dynamics that we see in the container market, the average duration across the feeder sizes have increased significantly on average. Now with vessels being fixed around 16 months. We also will look at some of our fixtures that we have done over the last 12 months, obviously depending on the vessel size, but the most recent fixtures that we have seen and that we have concluded are between 1.5 and 2 years, obviously adding nicely to the backlog. And on the right-hand side, you see the index of charter rates, and ever since January 24, with a little exception in October 24, the movement was upward only, and it seems so that there's a plateau that has been reached in December 24 and 25. Obviously, we all have seen the news around the ceasefire agreement between the Hamas and Israel, and subsequently the Houthi rebels have announced to stop attacking vessels passaging Yemen into the Suez Canal. For the time being, it seems that the whole situation is very fragile, and as a consequence, most of the liner companies have not started rerouting through the Red Sea and will continue trading the vessels around the Cape of Good Hope. As we see it now, it's a wait and see situation taken by the liner companies, and it will probably be so for the next couple of weeks and months. So we don't expect any sudden movements by the liner companies starting to reroute vessels again through the Suez Canal. So it will probably take some time until we see any change in the sort of business as usual that we have seen for the last 12 months. In terms of our own chartering activity, right now it is rather calm. We are shortly before Chinese New Year, which is historically speaking a rather quiet period, but we expect activity to be picking up after Chinese New Year. There's a few requirements by liner companies out there that needs to be filled. So we expect activity to be picking up. From an MPCC perspective, we have seen earlier our coverage is already at 85% for 25. So there's little tonnage available from our fleet for rechartering. So from that perspective, obviously less activity to be expected in 25 relative to 24. I mentioned the order book before. The order book in itself across the container market is very large. That is true. We like to drill into the details a bit. We have highlighted on the left-hand side The focus of the MPCC fleet, which again is between 1 and 6,000. In this instance, we're calling it 1 to 8,000 TEU. This essentially shows that the order book is heavily skewed towards the 8,000 plus TEU vessels. So more than 80% of the order book is accounted for 8 to 12, 12 to 17, and above 17,000 TEU vessels. In isolation, the feeder segment, the order book is between 5 and 8%, which again, in historical terms, is rather normal. There's a natural replacement need that we see, but more interestingly, and obviously that is a function of the non-contracting activity in the feeder segment over the last decade. More interestingly, 25% of the fleet is older than 20 years. And obviously with the pending, or I wouldn't say pending, but with the increasing regulatory pressure, there will be a lot of vessels phased out of the market. So on the right-hand side, we also try to show that there's massive recycling potential in the feeder segment. And if you combine the potential for scrapping, which obviously is driven by the regulatory framework, but also looking at the order book, which is normal and not oversized, there can actually be a squeeze expected at some point in the market from a feeder perspective. And again, we, with a fleet of 62 vessels and being the largest tonnage provider, should be very well positioned to capitalize from such event if it happens in the foreseeable future. From an overall market perspective, on the left-hand side, you can see that the utilization for the container market is very good. We're looking at less than 1% of capacities idling, and that obviously includes also vessels that are in dry docks. So you can think of a fully utilized fleet, which is always a very good sign. And then also on the right-hand side, you can see that the forward availability of vessels is reducing again significantly, which means that for liner companies, there's less tonnage available for chartering, and that also means more competition for vessel owners and vessel in our fleet that come open in the foreseeable future. Turning to the third chapter of the presentation today, the company outlook. Let us start with the chartering activity, which is a very good reflection of the market. As you can see, since Q1 24, the trend is very clear. So we have ever since concluded more than 30 fixtures, and you can see by the dark blue bars that the average duration of those fixtures has increased significantly. So in Q3 and 24, the average duration of our fixtures has been close to 2 years. But also the red line, you can see that the charter rates in itself have increased significantly, on average now fixing the vessels north of $20,000 per day, which based on our cash break even implies a very, very healthy margin that again is adding nicely to the profitability of the company. In Q4 and most recently early Q1, we have concluded 2 more fixtures for smaller vessels in the fleet. We're talking about 2 1,200 TEU vessels that we extended between 14 and 28 months at rates north of 17,000 for the shorter duration and north of $16,000 per day for the longer duration. On top of that, we have ongoing discussions on the remaining open position for 25. Obviously, the chart that we see here on that slide shows the number of fixtures, the average period, and the average hire. What it not shows is that also many fixtures that we have done were of forward nature, meaning that, for example, vessel that we have fixed in June last year are only starting their respective fixture in Q1 this year. So we're talking about more than 6 months fixing ahead. And that is also something that we're looking at now. So we have positions coming open mid this year. And those are positions that we're discussing with liner companies right now. Again, right now, the market is rather calm, owed to the fact that we have Chinese New Year coming up, and also that we have a change in the geopolitical landscape in the Middle East. But our expectation is that in the next 2 to 3 weeks, the activity is going to be picking up. The very good charter market that we have seen in 24 has translated, as I mentioned before, in a very, very good backlog. On the left-hand side, you can see the forward charter backlog, which now stands at 1.2 billion, which is actually a massive, close to 40% increase relative to where we've been 1 year ago. The projected EBITDA backlog stands at $800 million US dollars. And you can see at the bottom left that in 25, we're 85% covered. I just mentioned 2 fixtures that are not yet reflected in the coverage. So expectation is to be closer to 90% by the end of Q1 25, and also be closer to 60% coverage for 26. On the right-hand side, just breaking down our customer profile. Most of the fixtures that we have done in 24 has been with the top 10 liner companies. So more than 90% of our backlog, just to preempt some questions around, performance risk in regards to our backlog, is with the top 10 liner companies or cargo-backed owners. And the average duration of our contracts is around 2.3 years, so close to 2.5 years. We talked about capital allocation in the very beginning, and obviously shareholder return is very close to our heart. We have a very clear distribution or dividend policy, which is that 75% of adjusted net profits are being distributed to shareholders, which means that ever since we embarked on our dividend journey in Q4 21, we have up until today distributed close to $1 billion in dividends, which is a very good testament to our capital allocation policy. We have now 12 consecutive quarters where we paid our dividends, and on the right hand side at the bottom, you can see very, very compelling dividend yields. Obviously, the yields are based on the assumption that you acquire the MPCC shares at the respective beginning of the year. So that would have yielded investors between 36 and close to 50% simply in dividend yield. Very, very compelling. And again, the slide before, we have seen the backlog, which is locked in, which will perform, and which will also provide investors some predictability when it comes to the dividend looking ahead, given that we have a very clear formulated dividend strategy. Turning to the next slide and looking at the company transition, I mentioned before, we started out as an asset play and had a very rapid growth phase. Now we're looking at the value company. We want to continue with the dividend that we have paid so far. So if you compare Q3 21 to Q3 24, so essentially what has happened over a time span of 3 years, the backlog actually has increased despite having paid out close to $1 billion dividends, and also despite having paid down a lot of debt. So back in the days, we had only 3 debt-free vessels. Today, we look at 41. Again, 41 being 2/3 of the fleet being completely debt-free, which means there's a huge balance sheet flexibility looking ahead, but also the leverage ratio has reduced from 35 to 19%. And at the very bottom, you can see that we have also continued investing into eco tonnage, now making up close to 40% of our fleet. So in a nutshell, we used to have 66 vessels. We're looking at 62 vessels, so we did not significantly reduce the fleet. We have kept a steady number. We have maintained a very healthy backlog. We have started paying out huge amounts of dividends, and we will continue to do so going forward. We have reduced the leverage on the balance sheet. So we have adhered to the pillars that we have set ourselves in terms of capital allocation strategy. And to summarize, from a financial and operational performance, we are a very robust company, and also going forward, we will continue to operate on a low leverage. We have invested significantly. The number that was mentioned in the presentation is $600 million into new builds and modern second-hand vessels, but also retrofits. This is something we will continue to do going forward as well. I'm not suggesting that we will invest the same figure in the next 3 years, but there will be significant investments into the fleet renewal, which is necessary if you want to stay relevant and if you want to retain a sound asset portfolio that will continue to pay dividends going forward. We are in a strong market. We have talked about the most recent announcement in the Middle East. It still remains to be seen what the implications will be, at least from our perspective, for the foreseeable future, meaning the next couple of weeks and months. Not much will change. In the case that we will see significant changes in the trading strategy of our customers and the liners, and if we see less, so to speak, demand because a vessel will start rerouting through the Red Sea, there will be limited impact in 25 and 26 on us as a company, because the fourth point makes it very clear that we have a very, very strong coverage from a revenue perspective. Again, hopefully being closer to 90% by the end of Q1 for 25 and being close to 60% coverage for 2026. So that concludes the MPCC presentation and allows us to turn to the questions. So I would like to open the floor for questions from the audience. I do see a question concerning declining charter interest, and what is your take on that? Yeah, I talked about that it is a rather quiet period right now, which makes sense since you're being before the Chinese New Year, and you have an announcement a week ago more relating to geopolitical events. So from that perspective, it's no surprise that it is rather calm now. Irrespective of that, we have done 2 very good fixtures at the end of last year, and we have some ongoing discussions with liner companies on some of our open positions later in the year. And our expectation is that the activity will be picking up in the next couple of weeks. Then there's a question, what is your break-even daily rate inclusive of all OPEX and CAPEX and debt service, etc.? So we have obviously, I would like to answer the question splitting the fleet in 2. So we have the debt-free part of the equation, where we obviously have a lower break-even, given there's no debt associated. On that part of the fleet, our break-even is around $8,500 per day, which obviously is very nicely covered by the current charter rates available in the market. And then we have the part of the fleet which is levered. The levered part of the fleet usually also contains the longer term charter rates. There we have a higher break even of around $16,500 per day. But we have a very good cash flow visibility at rates significantly above the $16,000 dollars per day. So from that perspective, we have shaped the balance sheet to the extent to cope with the different scenarios that might unfold in the foreseeable future. Then we have a question on stock price performance. What do you anticipate your stock price will be in 12 months? If I knew that, I wouldn't be sitting here. I would only be trading stock on my private account probably. I don't have a glass bowl. It's very hard to predict. There's a lot of wild cards out there, and we talked about the Red Sea. We know that the new president-elect, or not elect now, he's president in the US, has a certain view on tariffs. So there's a 25 will be a very interesting year to follow. A lot of uncertainties. I hope that obviously our share price will be north of it where it is today in the next 12 months. And I mentioned before, I mean, obviously with the backlog that we have and the coverage, we are very much isolated to any curveball that might be thrown at us from a market perspective. So fundamentally speaking, there shouldn't be any detriment share price development, but obviously sentiment is also a factor that is hard to influence. And then we have a question, what are you seeing in the evolution of ports in terms of the demand for very small container ships? Are historical ports scaling up? Are new, smaller facilities being built to accommodate smaller ships? Usually speaking, you would see an upscale in port facilities. Obviously, building a port is a massive infrastructure investment, which will take time. So you're not building a port from scratch in 2 to 3 years. It will take up to 10 years. But it goes hand in hand with the economic development, obviously, of the respective country in which a port is being built. What we have seen, for example, is that there's investment in port facilities in the Far East. You have seen a reshoring, for example, over the last 4 years from China to other Southeast Asian countries, be it Vietnam, Philippines, Indonesia. So you do see some investments. Luckily for us, not to the extent that we would need to fear a cascading effect, pushing out smaller vessels and being replaced by larger vessels. And the next question is also Red Sea related. With regards to returning to the Red Sea, are the cargo owners the bottleneck or yourselves? I'm not quite sure what is meant with the bottleneck. I mean, obviously, we as a tonnage provider, we are not the decision makers as to how vessels are being traded. So it's at the discretion of the liner companies, and they have, for now at least, taken the decision that the situation in the Red Sea remains very fragile. Despite the ceasefire and despite the announcement of the Houthi rebels, and that also means that they will continue to trade around the Cape of Good Hope. What should be remembered also from a logistical perspective and from a port capacity perspective, if liner companies would start to all of a sudden put all the vessels again through the Red Sea, you will have congestions in the Red Sea, and you will also have massive congestions in Europe because you have vessels still trading Cape of Good Hope, and then you would have vessels taking a so to speak shortcut through the Red Sea, the Suez Canal, and they would probably call ports then in Europe at the same time, which would then, from a schedule perspective, would lead to massive congestion. So there's a lot of things that need to be taken into account by the liner companies, which will probably also mean that we don't see a sudden rerouting through sudden rerouting through the Red Sea. And then there's a question on return requirements when we buy vessels. So what return model do you use in deciding when it is attractive for you to buy new ships? Obviously, we would like, and we want, and we will, and we do. We want to achieve double-digit returns throughout the cycle. And that means is that we are aware of the volatility in the market. We would like, and we did play the volatility in the market right. But just purely looking at returns, obviously, which is an Excel exercise, is not the only KPI. We also very much look at managing residual risk, right? So, for example, right now, if you acquire ships, and we did acquire very good ships in the second half of 24, you're entering the market at, historically speaking, high prices, and we're trying to mitigate that by locking in long-term charters, paying down the risk to a certain level where we feel comfortable. So it's always, for us, it's always a combination of managing and mitigating residual risk, but also then obviously having a view on the asset and the lifetime of the asset. And, if the lifetime of the asset is sufficient enough, then we're pretty certain that we will hit a good cycle again, which then provides us with the expected returns. I don't see any further questions from the audience. Maybe we give it a few seconds to see if there are further questions coming in. It seems not to be the case. So then I would like to take the opportunity to again thank Capital Link and Nicholas' team for the opportunity to be present today. Always nice to be able to present to the investors and give an update on where we are today from a company's perspective. And I would also like to thank everyone for their attention.
Thank you very much for joining us today at this corporate presentation, which is part of the Capital Link's company presentation series in 2025. It has been a particularly interesting and insightful discussion on the company and the sector, and I would like to thank everybody for joining us today in making this so successful. I would like to remind you that the presentation and discussion will be available for replay upon demand on Capital Link's webinar website, capitallinkwebinars.com, and also on Capital Link's YouTube channel. Thank you to everybody for joining us today.